Live from Singapore, this is Insight with Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian shares in the green on optimism the trade war impact may see the Fed cutting rates sooner than expected. Progress in U.S. tariff talks with Korea and Japan also lifting sentiment. President Trump, meanwhile, insisting his team is talking trade with China despite a firm denial from Beijing. We'll assess the economic impact with the trade war with the IMF, which sees China and India taking the lead in global growth. Asia-Pac Director Krishna Srinivasan will be joining us exclusively in just a moment. And we get the outlook for Malaysia's chip industry as it works to move up the global value chain while juggling relations with China and the US. Well, it is risk-on relief in markets, including here in Asia. Global stocks up for a fourth straight day on signs of progress in trade negotiations. Also, as we said, Fed officials, including Chris Wallace, suggesting the Fed is open to cutting rates earlier than anticipated. The MSCI Asia-Pac Index at regional gauge currently up by 0.9%. We're seeing gains in China, Hong Kong up by more than 1%. Also, firm gains in the Nikkei 225 up as much as 1.8% in earlier trade. Now, to the latest on progress in U.S. trade talks with key partners in Asia. Japanese Prime Minister Shigeru Ishiba says his government has agreed on emergency steps in response to U.S. trade restrictions. Bloomberg understands that Japan intends to push back against any effort to bring it into an economic bloc aligned against China. Meanwhile, Finance Minister Katsunobu Kato says he strongly urged the U.S. to rethink its steps on tariffs in his meeting with Treasury Secretary Scott Bessent in Washington. Kato also says specific FX targets did not come up during the talks.
We reaffirm views that the foreign exchange rates should be determined by the market and excessive moves will hurt economies. Furthermore, we agreed to continue talking constructively on foreign exchange rates.
And South Korea says it's reached an understanding with the U.S. to prepare what it calls a July package on trade. The industry ministry says it expects a meeting with the U.S. trade representative soon. Earlier, Bessent said he expected a trade-focused agreement of understanding with South Korea as soon as next week.
We had a very successful bilateral meeting with the Republic of South Korea today. We may be moving faster than I thought, and we will be talking technical terms as early as next week as we reach an agreement on understanding as soon as next week. So South Koreans came early, they came with their A game, and we will see if they follow through on that.
President Trump, meanwhile, is insisting that his administration is talking with China on trade after Beijing denied any negotiations and demanded the U.S. revoke all unilateral tariffs. Let's bring in our China correspondent, Min Lo in Hong Kong. Min, he says, she says. What do you make of these conflicting comments from U.S. and China?
Yeah, both of them can't be right at the same time. So it really shows how the two sides are so far apart in their views that they can't even agree on facts. Because China is saying there are no talks whatsoever, but President Trump yesterday is saying that both sides have been talking daily and also that this morning both sides had met as well. Bear in mind, the U.S. is right now hosting a number of events, including the World Bank and IMF talks, as well as the G20 Finance Ministers Summit. And that means you have all these senior Chinese officials, including the PBOC Governor Pang Gongsheng, Finance Minister Lan Fo-an. They are in U.S. right now. So this is the perfect opportunity for both sides to have a face-to-face meeting for the first time since Liberation Day. But at least from the Chinese side, there are no official confirmation that there is any bilateral meeting going on. Although Trump says this morning both sides had met, he refused to give specifics of who met whom. So it's all a little bit mysterious. But again, it comes as China continues to demand that the U.S. remove all unilateral tariffs. But Lan Fo-an this morning saying that China is still advocating for dialogue on an equal basis.
understandably, Min, we know countries are looking for alternative markets given the U.S. tariffs. China seeking to repair ties with the EU. Where are we with that?
Yes, and this was first reported by Financial Times. China is prepared to lift sanctions on some EU officials that have been imposed in retaliation to Brussels' accusations of China's human rights record. And this is going to be a gesture of goodwill that could potentially pave the way to both sides, EU and China, picking up discussions of an investment pact that has been put on ice back in 2021 because of these sanctions. And again, this comes as we know that EU has been considering price commitments from China when it comes to EVs to replace those up to 45% tariffs on Chinese EVs. And again, another gesture of goodwill from China. In retaliation to those EV tariffs, China had opened up a probe into French cognac, but now China is delaying the conclusion of that probe by 3 months, easing off pressure on French producers. And we also reported previously that European officials are looking to make a trip to Beijing in July, signaling their willingness to engage with Beijing and fly all the way there when there was reluctance from President Xi to go to Brussels. Chinese Foreign Ministry saying they're welcoming these members of cabinet from the EU. Again, both sides leaning towards each other to counter the impact of Trump's tariffs.
That's right. A new world order in the making. Min, thank you so much for that. Bloomberg's China correspondent Min Lo out of Hong Kong. Now, the International Monetary Fund expects a trade war will lead to China and India playing a bigger role in driving global economy. Compared to the forecast it made in October, the IMF now expects a bigger share of growth to come from the Asian giants. Let's discuss this and more with Krishna Srinivasan, Asia and Pacific Department Director at the IMF. Krishna, good to have you with us. We talk about China in particular. I mean, you've downgraded China's growth from 4.6% to 4% for the year. I'm just wondering what this could trickle down to. Might we see contagion in Asia, economic and financial contagion?
Thank you, Haslinda. So yes, we have revised our growth forecast for China to 4% this year and 4% next year. It's a cumulative reduction of 0.6 percentage points relative to October. Now, Haslinda, we've also revised forecasts for all countries in the Asian region. In fact, if you look at Asia overall, we have it growing at 3.9% this year and 4% this year, next year, which is a cumulative adjustment downward of 0.8 percentage points, which is the sharpest adjustment since the pandemic. And it's not just China. In the case of, we revised India modestly a bit, but we have revised quite a bit for the ASEAN, and notably some countries which have large exposures in terms of exports to the US, because they're getting hit both by a decline in external demand, including from the US, and because they've been hit by huge tariffs. If you look at the ASEAN, Haslinda, for instance, countries like Cambodia, their share of exports to the US is about 40%. Vietnam is 30% and Thailand is 20%. And these countries have also been hit by tariff rates in the range of 40 and above %. So that explains why we have revised quite significantly ASEAN and also other countries, including Korea, for instance. Korea we revised down by 2 percentage points in the next 2 years. We have Korea growing at 1% this year and 1.4% this year. And in some sense, our projections for Korea are validated by what we saw in the first quarter.
Right. I'm just wondering, though, do you expect China to weaken further from here? After all, we've not seen the full impact on exporters, yes, for instance. And might that trickle down? Might you have to relook at your numbers again?
Absolutely. So Haslinda, the numbers I gave you is based on what we call as a reference forecast. These forecasts are based on the tariff scenario which prevailed on April 4th. So whatever happens since then is not internalized in this reference forecast. But what we have done also is we have done a top-down forecast. As you know, Haslinda, the way we do forecasts is a bottom-up. All countries provide their assumptions, and then we aggregate it at the regional and global level. But since we didn't have much time after April 4th, for what we have done is we've done a top-down scenario where we look at what happens to global growth and growth elsewhere when the tariff pause is more permanent. There, what we find interestingly is that global growth numbers don't change as much, but regional differences are large, and Asia gets hit much harder there. Because of
China
sorry, go ahead.
I want to talk about China. It's trying to rebalance its economy. It wants to rely more on domestic consumption. It's taking efforts to do that. How would you rate China's efforts? We know that, the trickle-down effects is going to take quite some time before it can be reflected in its growth numbers. How are you assessing the efforts being taken by China?
So if I had to sum it up in one line, I would say all the efforts are in the right direction, but it's not enough. If you want to rebalance, China needs to do more in terms of, one, rehabilitating the property sector. We have put out numbers in the past which said that the central government needs to spend up to 5% over 3 years to fully fix the problem in the property sector, notably finish the unfinished housing, take care of the non-viable developers and so on. And it also needs to put more money to beef up social safety nets. So all those things are important. What we've seen is some movement towards the social safety nets in terms of fixing the retirement plan in China, also increasing retirement, the pensions in the rural areas. So they have made some efforts towards both trying to fix the property sector and try to build social safety nets. But these are small steps. Much more effort is needed to have that rebalancing away from export-led growth to more domestic demand-led growth.
We've seen how China has been fixing its currency weaker than anticipated by the market. Do you see a devaluation coming, like what we saw back in 2015? And what impact would that have? What risks are there of a devaluation in the Chinese yuan?
So Haslinda, the change you mentioned, the weakness you mentioned, is very small, right? So far, over the past 2 or 3 years, they've kept the exchange rate pretty much at a quite stable level. It has only recently you saw some fixing at a slightly weaker rate. Again, that's very modest. But the point I would say is that if they don't rebalance enough, then already you see signs of the rising signs of deflation. That and if domestic demand doesn't pick up, you're going to see more deflation in the economy, lower export prices, and that can have spillover to the rest of the world, where you see Chinese goods being much cheaper in rest of Asia and rest of the world, and that could be that's the kind of spillover other countries don't want to see. So clearly, more efforts are needed to rebalance the economy, in particular to push up domestic demand. And also, when they try doing that, they can give a greater role to the services sector, right? And if all of that is done, then you can see greater rebalancing. Right now, what we see is some modest steps in terms of social safety nets. They're trying to pump up the trade-in program, but all that is not enough. Much more is needed.
When you take a look at the tariff war right now, Krishna, I'm just wondering, what are the hidden risks? What are people not talking about enough?
So, the one thing which we've talked about is the fact that uncertainty right now is at a very high level. In fact, it's off the charts. And if you look at, uncertainty and also predictability, right? In terms of what can we expect in terms of a trading environment which is clear, stable, and predictable. You don't see that. The question, of course, is how do these negotiations proceed? It's clearly the U.S. is doing it country by country. As you noted earlier, they've had beginning negotiations with Japan, Korea, and so on. How these things pan out, what does it mean for the smaller economies in the region, which have been hit hard, right? Like Vietnam, Cambodia, Thailand, these are all much smaller economies. How do they go from here? How do these trade negotiations, what do they result in? I think it's very unpredictable at this point in time. So it's very hard to say. And that's why we're saying that, to our forecast, there are significant downside risks, both related to heightened uncertainty, what happens to financial conditions. All that it's quite unpredictable at this point in time. So that's why we say, to our reference forecast, there are significant downside risks.
Adding to the issue, of course, is the weakening dollar. Year to date, most Asian currencies, bar the Malaysian ringgit, is actually up against the USD. The yen, in particular, higher by about 10%. This comes at a time when exports are at risk. How do you see, central banks around in Asia balancing growth and fighting inflation when currencies are also rising versus the USD?
So one thing I would say is that if you look at Asian economies, let's keep Japan aside, inflation across the region is at or below the target rate. So which means that central banks in the region have much more space to ease monetary policy. Of course, then the question is, if they ease monetary policy and if the interest rates are higher for longer in the U.S., that could have implications for the currency. So what we are advising countries is let the exchange rate be the shock absorber. Let monetary policy provide you the space you need to adjust to the shock, because we feel that Asia in particular does not have much by way of fiscal space. So you want the exchange rates to adjust, to be the buffer against shocks. Monetary policy, there's room to ease. And if exchange rates become very volatile, and there's a lot of volatility in exchange rate markets, then in some cases we see the role for intervention to limit volatility. But overall, we think that exchange rate should be the buffer against shocks. There's room to ease monetary policy. On fiscal, we believe that consolidation is what is needed, given the fact that most countries in the region spent a lot in the fallout from the pandemic. But again, we say that if there is a need for providing fiscal support, do that in a targeted way and in a time-bound manner, so that you balance between providing support to the economy while making sure that the fiscal integrity is maintained.
Are any of the economies here in Asia at risk of slipping into deflation? And linked to that, what do you see the situation in the U.S.? How might that play out here in Asia?
So to your point, two countries where in China, for sure, the deflation risks have gone up. In fact, you look at the numbers, there have been several quarters now of negative growth in GDP and also in headline inflation. So deflation risks have clearly risen in China. The inflation is also pretty low in Thailand, right? So what do the tariffs do? The tariffs for in a country with the imposing country, which is the U.S., this is a supply shock. But for countries which are the recipients, the countries which are being hit by the tariffs, it's a demand shock, right? So they have to deal with that demand shock. In the case of countries where we see these deflation risks pretty significant, we see the room for both. In the case of China, for sure, we see room for more monetary easing. We also see room for fiscal easing to support the rebalancing. You need that. That can get you out of the deflation territory.
Earlier, Krishna, you talked about how you see downside risks to the economy here in Asia. How do you compare that versus the U.S. and Europe, for instance?
So clearly the U.S.
The downside
also,
risks.
Yeah, I think our point is that the downside risks are there to the global outlook, which includes the U.S., but they're also equally relevant for countries in Asia. So yes, there are the uncertainty. The uncertainty remains pretty high, not just for Asia, but for all of the world, including the U.S. Markets are very volatile across both advanced countries and emerging markets. I must say that in the case of Asia, the equity markets have been a lot more volatile. If you look at currency markets and bond yields, they've been much more stable compared to equity markets. And that's also the case in equity markets in the US have also been very volatile. So these are the kind of risks. How do financial conditions adjust? What will happen to commodity prices? All these things are quite unknown at this point in time. That's why we see the risks are to the downside, not just for Asia, but for the rest of the world too.
But are you comfortable with the fundamentals you're seeing in Asia right now? Are there vulnerabilities that take you back to the days of the Asian crisis, Asian financial crisis, for instance? Are you concerned?
See, if you compare the Asian financial crisis and where you are right now, a big difference is that policy frameworks, institutions have really gained credibility in Asia. With be the independence of central banks, inflation targeting, making sure that you don't have too much currency mismatch in balance sheets. So there's been huge amount of policy and institutional reform in Asia since the Asian financial crisis. So fundamentals in Asia are much better. You cannot even compare the Asian crisis now. Fundamentals are much better. However, this is a region which has relied a lot on exports, right? If you look at the pre-pandemic trend, then domestic demand has not recovered at all, has not recovered quite a bit in emerging Asia. Right? A lot of it is depending on exports. So to the extent that this region depends a lot on exports and external demand is weakening and tariffs are being imposed, it's a double whammy for this region. So that's why it's imperative that the region as a whole pivot towards greater balance in its growth model, towards more reliance on domestic demand than it's been. And for that, to have a stronger domestic demand rebound, you have to have structural reforms which can underpin a pickup in consumption on a more durable basis, a pickup in investment. Even in countries which are doing quite well in terms of, you look at India, where growth rates are, it's 6.2 and 6.3%. The headline numbers are very good. It's the fastest growing major economy. But even in countries like India, private demand is very weak, right? So in countries across Asia, depending upon the country we're talking about, either it's consumption very weak or investment which is very weak. And so domestic demand needs a lot of support, both through macro policy and through deeper structural reforms. And that pivot will help Asia recover on a more durable basis from this shock.
Krishna, there's a huge concern about the region's external debt. This is a region with huge external debt. Is it able to handle outflows, for instance? Are you confident it will be able to manage?
See, at this point in time, if you look at the debt situation, I won't say it is equally bad in all countries, right? It is, yes, debt levels have risen. In fact, the number I quote is, from 2007 to when it was 25%, now, something like it's more than 35% of Asia accounts for more than 35% of global debt. The number is rising. Again, a lot of that is China. So, and for China, we say that, they have some space to provide support in the near term, but they have to embark on medium-term consolidation. But overall, a line on debt is that, on debt on fiscal, is that you have some space in some countries, but overall the stance of fiscal should be more more along the way of consolidation. And where you want to provide support in response to these shocks, it should be targeted and very much time bound. So yes, debt levels have risen, and that's why we're pushing for greater consolidation in the region, notably in some countries.
Krishna, is there reason to be concerned about Indonesia? Its currency, one of the worst in Asia right now, along with the Malaysian ringgit, and it has that high debt. The government, in fact, the central bank has been supporting the currency in a big way. Is there reason to be concerned about Indonesia?
So I mean, I talked about the ASEAN before. If you look at Indonesia, their exposure to the U.S., it's at a very small number. Only 10% of their exports go to the U.S., right? And if you look at the tariff rates on Indonesia, I just said I'm looking at a number here. It's about 32%. So the external shock to Indonesia is much less contained compared to other ASEAN countries. Also, commodity prices are moving. So for Indonesia, the external shock itself is not as such a big drag as it is some other ASEAN countries. What we would suggest is it's important to maintain the fiscal discipline, and I think they've done a good job there in trying to stick to the fiscal deficit target. So I think it's important that they stick to that. The fundamentals are pretty good, and they have the space going forward to also ease monetary policy. I think overall they are in much better shape than some other countries in the region.
Krishna, as we speak, we have breaking news. China weighing exempting some U.S. goods from tariffs, and that's because of our rising costs. We're talking about suspending its 125% tariffs on some U.S. imports, including medical equipment, industrial chemicals like ethane. Now, the exemptions being considered also include plane leases, as Chinese carriers rely on leasing fees to use some jets and would be financially ruined by the additional tariffs. What's your reaction to what we're seeing right now?
So I need to look at the news. I need to absorb the news. But I would say, Haslinda, that we're urging all countries to work constructively to resolve tensions and provide a much-needed, certainty, right? And they can do that by promoting a clear, stable, and predictable trade environment. And that falls on every country. And then also we're saying that countries can pursue pragmatic cooperation and deeper integration to regional, cross-regional trade agreements or non-discriminatory reduction of trade barriers. So I think what you just read out to me seems like a step in the right direction, which is along the lines of what we would think. But I need to absorb the news more to actually give you a commentary on that.
To that point, Krishna, I'm just wondering what concessions you think China can make to allay the tariff situation between the two sides.
I think the bigger problem with the meta problem, which a lot of countries see with China, is the fact that this is an economy which is largely dependent on exports, right? It's and with inflation being very low, in fact, close to deflation, export prices in China have also declined, and so it's huge competitive advantage it has, and that's why it's exporting a lot, not just to the rest of Asia, but to other parts of the world. So the meta problem people have with China is that it relies a lot on exports. It does not over the years, which has led to imbalances. So they need to pivot towards greater domestic demand. So that is what people will be looking at in terms of is China doing enough to make that pivot? And that would be the meta point compared to whatever else we just talked about.
And might India benefit in the longer term with the tariffs imposed by the U.S. on China?
I think it definitely provides an opportunity for India to compete. But again, as I mentioned to you in the past, that again, a lot of reforms are needed in India. If India wants to compete with China and with other emerging economies, it needs to embark on greater reforms. Trade liberalization is one. Reforming labor codes is one. Is the other. Then you have push on infrastructure. There are many reforms which are needed, and the symptomatic of that, of what is needed, is the fact that private investment in India is still very muted. It's at 22% of GDP, but if you look at investment in machinery and equipment, which adds to productivity, that's been pretty sluggish.
Krishna.
So private investment needs to really pick up in India for it to be able to compete.
Krishna, thank you so much for that. Krishna Srinivasan, Asia and Pacific Department Director at the IMF. This is
What will derail the economy is tariffs. Pricing power, it will go towards dealing with the tariffs and not towards margins. This could be a very difficult period for U.S. stocks.
The relief that we're seeing in markets is a little bit premature. At the end of the day, I think even if we do get some kind of reduction in tariffs from where maybe they were sort of announced a couple of weeks ago, it's still a significant increase in tariffs.
We're not necessarily concerned that tariffs per se will lead to inflation. What we are concerned about is that they could, maybe potentially temporarily depress economic growth because of the lack of clarity that American consumers and American businesses have at this stage of the game.
some of our guests this week sharing their insights on how higher U.S. tariffs will impact markets and the economy. And speaking of tariffs, we just had breaking news that China is weighing exempting some U.S. goods from tariffs as costs rise for its companies. And that must be some relief for the world in particular. We're talking about suspending its 125% tariffs on some U.S. imports, including medical equipment, as well as industrial chemicals like ethane. And of course, let's take a look at where we are in terms of the currency as well. The yen falling as China weighs exempting some of those U.S. goods from tariffs. So it's all good news in this tit-for-tat trade war. Of course, this is, according to people familiar with the matter, yet to be an official statement from China itself. Now, staying with the trade wars, Malaysia says it will slash its outlook for growth this year as it faces a 24% so-called reciprocal tariff from the U.S. is one of several Southeast Asian nations caught in a trade crossfire. Avril Hong joins us with the details. Avril.
Absolutely, Has. I mean, you talk about that progress potentially, right, based on sources of U.S.-China, maybe at that détente. But we're also hearing from the likes of Malaysia how they've begun those trade talks with the U.S. And Malaysia is saying that it is open to fair trade, maybe reducing the trade deficit with the U.S. But you know how this is ultimately creating a lot of uncertainties when it comes to trade, when it comes to investments for Malaysia. And as you say, that growth outlook likely to be slashed. The second Finance Minister, Amir Hamzah, is saying that they'll be released in the next couple of months. The current projection is for 4.5% and 5.5% for Malaysia. IMF, in the meantime, sees it coming at 4.1%. Now, what all this does is really draw attention to what's fueled Malaysia's growth in the past couple of years, and those are the tech investments, particularly from foreign firms, some of the factors at least. And when you look at how things have stacked up, like tens of billions from US, European, Chinese firms even as well, right? And this is helping to move Malaysia up the chips value chain. You know, it's a big player when it comes to assemblies and packaging, but it's also underpinning growth overall and helping to build out the tech ecosystems when it comes to chips data centers for the likes of Johor State as well as Penang. So that's something that we've been really keeping a close watch on. But keep in mind as well that given the tariffs, the uncertainties, the commitments from some of these firms, there's not much clarity yet on that. The other factor to consider when it comes to these tech investments is the element of DeepSeek, how that's prompted revisiting how much data computing power is actually needed. Does that affect data center investments into Malaysia? Some of the factors that we're watching when it comes to tech and particularly chips in the country.
That's right, Avril. And just to put a number to it, Malaysia itself committing over $100 billion to develop its chip industry. Avril Hong, thank you so much for that. Now, Malaysia plays a key role in the global semiconductor industry, mainly in back-end operations like assembly, testing and packaging. Let's get the outlook for the sector. Joining us exclusively from Penang is the president of the Malaysia Semiconductor Industry Association, Wong Siew. And of course, Penang is the heart of the chip industry in Malaysia. Thanks for joining us, Siew Hai. First off, we heard from Avril earlier about how Malaysia is in talks with the US to get perhaps concessions. I mean, how confident are you that something beneficial will come out of the talks?
Yeah, I hope it will be beneficial because Malaysia has been in the semiconductor industry since 1972. And since then, we have helped the small SMEs like companies like Intel during that time, AMD, HP, grew by leaps and bounds through the last 50 years and to what they are today as global giants. So that's, you know, the kind of support that Malaysia has given, and they have grown to such big companies. So I think that counts for something. And if you look at where we are today as a country, where we are strong in assembly tests and automation, we are giving tremendous support to the semiconductor industry. That will help the American companies to flourish. And so we hope that by being so-called strategic partners, we can help each other to flourish.
Well, the thing is, you are playing, by you, I mean Malaysia is playing both sides. We had Xi Jinping visiting Malaysia recently and Malaysia committing to greater cooperation with China. Can you continue to stay neutral, especially in the tech and chip sector?
Well, you know, Malaysia have announced many times that they are neutral and non-aligned, and they are open to supporting both countries, and not just both countries, but the world, to get the semiconductor industry grow. And being a significant semiconductor hub, I think we have the opportunity to seize the opportunity to support the US at the same time to support China and to support the rest of the world. I think it is workable.
The U.S. has, of course, been up in arms. It is making allegations about AI chip smuggling. Could you shed some light on where you are with that and where Malaysia stands on that?
Well, you know, the Malaysia, at least YB Zafrul, the Minister of International Trade, has already announced that Malaysia will sign an agreement on to safeguard technology. And that will help, hopefully, any diversion of chips to China, to wherever that the chip is not supposed to go. And I think it is very clear, at least from the Malaysia Semiconductor Industry Association, we have announced very specifically that all companies must comply to the requirement of the US to ensure that chips are not going places they're not supposed to go. So with that message, with that programs that the government is trying to do, I think we should have that under control if everybody put in the effort to make it happen.
The thing is, with a lot of uncertainty, companies, big tech companies are also rethinking their investments in Malaysia. How much of a dent has it already caused Malaysia?
Okay, I mean, with the tariffs that is going up, like earlier you mentioned about 24%, and we have some exemption already for the semiconductor chip, as well as the some of the announcement for the computers and smartphones and so on. We are having something like 58% or 59% of the chips and the industry having the exemption. So we only have something like 40% that is having that non-exemption where we will have to pay the tariffs. But however, I think if you look at the relative tariff hike throughout the world, this is going to cause a drop in demand, basically just purely because of the impact to the global economy as well as the US economy, and therefore you will see some impact for the semiconductor demand. But however, for Malaysia, it is important to note what is the relative tariff rate versus the other countries. But if we are lower and still have tariffs, but we will then become more competitive because of our lower tariff, but also because of the ecosystem that we have and the 50 years of experience that we have, we are able to compete with the rest of the world. And therefore, there is more opportunity for other countries to consider Malaysia as their +1 strategy. So we will see some benefit if that's what it is. But we hope that tariffs will go lower because of the relationship that we have with the US and support that we have given to the US for such 5 decades.
We know that the US has a chip whitelist. How many Malaysian companies are on it?
The whitelist, what I understand, there's one. All the years are in yellow. So we are working hard, trying to work with the US government to find out how do we move from yellow to white. And I think we can achieve it if we put put effort and understand the requirement that is needed to move from yellow to white.
Siew, given the tariffs we're seeing right now, has it impacted Malaysia's own chip ambitions? We know that it's setting aside $100 billion to build the industry. It wants to climb up the value chain. Has there been a pullback in terms of its ambition?
Well, I tell the government that now is the time to accelerate the national semiconductor strategy. In fact, we should move faster now. This is the window that we should move. And I don't think it has dented us. I think we need to move up the value chain, strengthen where we are, take this opportunity to improve on the cost reduction, cost efficiency, and productivity. At the same time, work on the supply chain, look at alternatives, how can we improve, and same time, work with the customers and the partners to see how can we navigate this together and bring out a better outcome for everybody. So with that, I think Malaysia needs to put even bigger effort now to strengthen itself and move up the value chain. I think we will be then.
What initiatives would you like to see from the government?
Well, the government has already announced in the KL20, remember, that they are going to put in a sort of a financing program through the GLICs, the government-linked companies, together with other VCs to create funds to help Malaysian companies to grow and become global champions. So they have already targeted 10 IC design and advanced packaging companies to be created over the next 10 years. And we are working hard to get the technology, working hard to get the talent, and getting the universities to work together with us to build up that strength and ecosystem to allow the companies to move up the value chain. And one of the most recent one was the partnership with ARM to allow companies to leapfrog instead of creating their own IPs, to leapfrog by using ARM IPs to get into design and IC design. So we hope that we can move faster in the next few years.
Siew, for the industry, how do you think the tariffs will reshape the chip global supply chain. We know that during Trump 1.0, we had companies investing in a lot of the countries here in Southeast Asia as a China Plus One strategy. A lot was invested in workers, in skills upgrading, in factories, in manufacturing, and very little is left for it to then move yet again. So I'm wondering how the global supply chain, to what extent the global supply chain will move and change yet again.
Okay, I think let's look at the current situation. The current situation, and there's a pause. And during this pause, of tariffs, three things happening to the companies. One is that there is not much change in demand, okay, which means that the companies are still shipping to the current demand. Two is that there are companies who are pulling in demands. And three, there are companies that the customers are telling them to hang on and defer shipment. But the bulk of it, more than 60% of it, are all business as usual. Now, with the tariffs, when it comes in, they are doing a scenario analysis to see how can Malaysia position itself in a much better position than what they are today, even with the tariffs. And if you assume that the tariffs were what President Trump announced previously, and if it is going to be about the same, then we have the opportunity to position Malaysia to be globally competitive. And therefore, with a strong ecosystem, and we're going to strengthen it further, we expect more investment actually to look at more companies and countries to look at Malaysia as the alternative or the plus one.
Right.
So we'll see. We'll see how the whole tariff plays out.
Siew, thank you so much for that. Wong Siew, President of the Malaysia Semiconductor Industry Association. Now, let's do a check on how markets are doing. We know that the Nikkei 225 poised to erase the losses since that tariff announcement, and by that we meant China. It is weighing, exempting some U.S. goods from tariffs of 125%. Of course, we're seeing costs escalating for Chinese companies if it does impose those tariffs on U.S. goods. The Nikkei 225 currently up by almost 2% right now. The topics is also trading higher. In terms of the yen, 143.42. Currently, the Japanese yen is down by about 0.6%. Of course, the Japanese yen has been an outperformer this year, up about 10% year-to-date versus the USD. Now, still to come, this week's deadly attack in Kashmir has suddenly ramped up tensions between India and Pakistan. We speak next with the Center for Land Warfare Studies for insights into the crisis and paths to de-escalation. That conversation coming right up. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Fed Governor Christopher Waller says it's unlikely unemployment will rise if President Trump's higher tariff regime is reinstated. Speaking with Bloomberg, he thinks those tariffs won't have a significant impact in the near term.
It wouldn't surprise me that you might start seeing more layoffs, a tick up in the unemployment rate going forward, if the big tariffs in particular come back on. The smaller tariff world of 10 to 12%, most of the firms I talk to, they figure out they can deal with it. They kind of often give me this kind of formula. Our suppliers will eat a third of it, we'll eat a third of it, and we'll pass a third of it on to consumers. So if you're talking about a 10 to 12% tariff, it's not a big price hit to the consumers if that's all they pass through.
But economics tells us that tariffs in general are not good. So even if we get the smaller tariffs, does that still leave business on the sidelines and growth prospects lower?
Well, it is a tax, and it's inevitable that there's a tax. But however, I've always tried to tell people that, given the fiscal situation we're in, we need to get some better control of the budget deficit, and that means some combination of taxes and spending. It's just an argument, what taxes do you want to have to raise? So nobody likes taxes. I don't like taxes. But if you're going to get any kind of get our fiscal situation under control, you're going to have some tax revenue, and there's no obvious reason why tariffs should be off the table per se.
We have some tariffs in place, even though the president goes back and forth about other tariffs, but he put some on in March. When do we start to see that in the hard data?
Well, by taking off the April 2nd tariffs, you've postponed that decision till July. So we'll see some of the 10% tariffs and the auto tariffs. Some of that will start coming through particular sectors. But it's not likely to me that by July 1st, you're going to see really big impacts from it. You will see it, like I said, in CapEx and things like that have just been put off to the side. So you'll probably see some softening in the data, but you're probably not likely to see anything dramatic happen before we get a better decision from the administration what they're going to do with the big tariff package that they initially proposed on April 2nd.
Well, what will we see first, a big rise in inflation or a slowdown in growth, perhaps epitomized by the unemployment rate?
I think you could see both of them almost happen at the same time, just in the sense of, like I said, that firms have to make a decision right away to pass through. Now, they have a lot of firms told me they have price contracts, so they're protected for a little while until they have to renegotiate those price contracts. But they're all anticipating, particularly the bigger tariffs, they're all anticipating they're going to have to cut costs somewhere. And the easiest thing to do when firms have 65 to 70% of their costs is labor, to start shedding some labor. So you might see layoffs start to happen about the same time you start seeing prices going up.
And that was Fed Governor Christopher Waller speaking with Bloomberg's Michael McKee. Now, Bloomberg has learned that China's government is considering suspending its 125% tariff on some U.S. imports. Sources say this is because the economic costs of the tit-for-tat trade war are weighing heavily on certain industries. Let's bring in our Bloomberg MLive strategist, Mary Nicola, for the market reaction. And we've seen some turnaround. We've seen the reaction from the yen, from the Nikkei as well.
Yeah, we're seeing a lot of reaction coming through from the havens that we've seen. So, for example, the yen, the euro, gold, they've all benefited from headlines that have been very sort of for anti-trade and where the risk-off really comes in. That's where you see traders moving in towards. But now, because of this headline and this more conciliatory tone that we're getting, not only from China, but also from the U.S., is easing some tensions and just giving traders a huge sigh of relief.
But it doesn't change the fact that this is a market that's headline-driven.
True.
It could be positive right now. Maybe in 2 minutes, we have another headline, and down we go.
Absolutely. So I think one thing that we are guaranteed, no matter what, is volatility, right? So this is what we're going to continue to see in the coming days, just because, or in the coming weeks, is because of the fact that everyone is so focused on these tariff headlines. Everyone is so focused on trade. And so what we're seeing is this reaction where volatility just carries through and is going to permeate throughout. So that's not going to change. And as you said, we have a positive headline, but 2 minutes later, we could have a negative one.
I mean, we talked about how in recent days we've seen some positivity and hence, the gains in the equity market. I'm just wondering, how are investors positioned right now? What are they positioning for?
It's a good question because I think everyone's a little bit on the fence, right? But I think one thing that has been clear with the price action has been to sell America. I think that theme really sets up high. But what did throw a wrench into things is just how Alphabet performed. And so it's showing that earnings are doing fairly okay and that we're pretty strong on that end. So throws into question this whole thing about tech and where tech valuations are and do they actually make sense where they are. So, but I think one thing is clear is that we're expecting a growth slowdown. We're expecting globally, especially if this doesn't turn around. So one thing, and then of course, because a lot of the volatility is coming from the U.S., you're still going to have a lot of U.S. assets being sold. I think where you do come out on top is like domestic equities in Europe that could actually see further gains. I think EM is in a precarious situation because of the fact that you have the two economic powerhouses that are pulling them in opposite direction, and of course that they're going to slow down. So where is the growth coming from to generate growth in emerging markets?
Quite interesting that we're seeing significant inflows into Japan.
Yeah, absolutely. Well, at the same time, it's a haven, right? So you're going to see that increase, whether it's for bonds, less so I would say for equities, but I think bonds end up being the bigger winner here. Because at the same time, yes, we saw inflation was a little bit hotter. Tokyo CPI was a little bit hotter than expected. But we do have to remember that the adjustment that we're seeing in the currency, the gains we're seeing in the currency is tightening financial conditions. So as long as that continues.
Which will weigh on exporters. And we're talking about 10% 10% increase in the yen versus the USD.
Absolutely. But it's such a sigh of relief for a lot of the domestic producers and the ones who are dependent on inputs, right? So yes, you'll see like the big exporters like Toyota, who benefited so much from the weak yen, they're going to start seeing a pullback. But at the same time, a lot of the domestic producers and a lot of the domestic companies were crying over the fact that the yen was too weak. So it's a bit of a mixed bag for them.
And even as we talk about an improvement in sentiment, people keep buying gold, and some say it could get to 4,000 now.
Well, the main thing here is that we don't know where inflation is headed. Even the central bankers don't know where the inflation is headed, right? So we've talked about some have said that it could just be transitory as a result of the tariffs, but the reality is that we don't know. And and of course, investors are preparing for that. So where is your hedge in an environment where you could potentially get stagflation, right? Where you can see where we're expecting slower growth, we're expecting higher inflation. Seems like gold is the winner here.
Let's see where this goes. Mary, thank you so much for that. Bloomberg analyst strategist Mary Nicola there. Now, before we go, here's a look at our guests for next week. Federated Hermes and Morgan Stanley will be joining us for market analysis as we await key rate decisions and economic data out of Asia. Plus, we speak exclusively with the CEO of Hindustan Zinc as they prepare to release their latest earnings. And that is it for Inside. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.